Hello, everyone. It's a pleasure for me to welcome you all to this joint webinar with Kairos and Veyt today, where we will look at the carbon market outlook, EU ETS price risks and opportunity. And it's a pleasure for me today to be joined by Paul Vikus. Sorry for my pronunciation, but hopefully it will be some interesting 45 minutes this webinar. So a bit of housekeeping first. It's an available Q&A panel where you can ask questions. We'll have a Q&A session towards the end of the presentation, and hopefully we will be able to answer most of the questions that will pop up during the webinar. Yeah, and as I said, estimated time 45 minutes. And then first, a bit kind of a few words on who we are at Veyt. So we are a market intelligence company with focus on kind of net zero market solutions, where we have products on renewable power, renewable fuels, European carbon, and global carbon markets. And today we'll focus on the EU carbon part, but please reach out to us if you want to see kind of more on what products we are offering across kind of all the different markets. And Paul, over to you.
Thanks, Ingvild. So at Kairos, we are a geospatial specialist company, so focused on energy and environmental markets. So here you will be able to see a big list of projects for which we cover lots of energy markets. So for example, we have plenty of products available for the oil market, gas market, power and carbon, and also some additional products around equities and other sectors such as mining, automotive, or retail and consumer. And today, so the project that we will use is a Carbon Watch, so a project that focuses on the EU ETS market, where we measure and deliver to customer the real-time emissions of this market.
Thank you. And then today's agenda. So first we'll take a look at what has happened so far this year. And then we'll kind of take a deep dive into 2025 emissions before we look more on kind of the market dynamics and outlook in the EU ETS, bit kind of shorter term. So what has happened in this market this year? I mean, this is prices just going back 1 year. You will have kind of the yearly averages in the bars to the right. But of course, kind of we had a bit kind of an optimistic start to the year. I would say already kind of in the end of last year where prices were trickling up. We had, of course, kind of the December option expiry, also kind of feeding into this equation, but also kind of this prospect of tightening. We have had kind of quite a long time when market participants and us as analysts seeing kind of this future tightness, and that was kind of also playing its part in when kind of prices were moving up in December, January. So then prices came up to roughly kind of the same price levels as we saw kind of in 2022 and 2023. But that was before Trump took office in January, and also kind of this tariff with the tariff threats was probably more or was more kind of severe than everyone else expected up front. And when he took office, that kind of fear just trickled into the EU ETS market with quite a lot of risk off in the market. And then prices were stabilizing around kind of 70, 75 a bit before kind of we saw another drop towards 60 when the tariffs was actually announced, and it was kind of showing it was no one was shielded, and it was quite much severe than upfront expectations. then after kind of we saw some delays when kind of the implementation of tariffs. So things have been stabilizing a bit kind of after that, with prices trading around 70-75 band for quite a bit of time. Throughout kind of June, July, and August, there were kind of little action in the EU carbon market. But then when everyone was back from holidays, policymakers, all kind of market participants was back in the market. We have seen kind of this break out of this rather sideways range. So this technical picture has changed, or it was changed kind of to bullish. And of course, kind of also compliance season is the end of September, so a bit kind of underlying support also for prices. We've seen kind of activity as well picking up quite a bit during September. And it's on my slide that kind of coal was in the power mix for the start of the year, but now I'll kind of hand over to Paul to guide you through kind of what has actually happened on the emissions side of things.
Yeah, thank you very much. So just to give you a little agenda also on the 2025 emissions. So I'll start with highlighting the current emissions that we measure for this year. Then I'll explain quickly how do we measure those emissions at Kairos, so in real time. And then we'll deep dive into each sector to not only observe but also understand the different dynamics in the sectors. So that's the numbers for the year. So we do observe a surprising rebound for the year-to-date emissions. So for this analysis, I've stopped the measure at the end of August, so data will be from 1st of January to end of August. And we can see that this increase is in reality split into two distinct phases. So when you look at the first half of the year, so that will be the last part of the slide, here we observe, so we compared, sorry, the first semester, so the first half of 2025 compared to the first half of 2024. And the result is a total increase of 2.6% in emissions compared to last year. And you can see also the split by sector. So what's a surprise is that only industry has seen emissions drop in the first half of the year, so by 1.2%. So this is mainly due to the steel sector, so we'll see it later, with a very difficult economical situation for this sector. But for the rest of the categories, they are all seeing an increase. So one by one, so if we start with shipping, so there is a plus 61%, which is mainly due to regulations. So I think you may all know that shipping emissions were added to the market last year, but only 40% were taken into account into the so for the total ETS emissions. This year, this is up to 70%, so which is explaining this increase, and it will be fully taken into account next year. Then for aviation, we measure an increase of 4.7%. So this is the first year where we are above pre-COVID levels. But this increasing trend is the same since COVID. So this is really the recovery of the aviation that is now surpassing the 2019 year, so before COVID. But I think the biggest surprise is for the power sector, where we did measure an increase of 1.1% compared to the first half of last year. And we'll also explain this a bit more after, but this is due to really unfavorable weather conditions for renewable electricity generation. Overall, now if we look at the total, so for the rest of the year, so from also the months of July, August, September, we can see really the two distinct phases of this emission. So the first part of the year with a big increase compared to last year. So that's particularly visible when we look at the numbers for the first quarter. So if we compare the first quarter of this year compared to last year, that's a plus 7%, almost 7% for this year, so plus 20 megatons in total. So really driven by power, as we will see later. And then for the second and for the beginning of the third quarter, we are back to more, let's say, a normal situation with a decrease of emissions of 2.3% in the second quarter and already 4% for the third quarter. But as of today, emissions are still above the level of last year, which is quite surprising. So if you move to the next slide, I'll be able just to quickly explain how do we measure those emissions at Kairos. So to do so, we leverage very different sources of data, so that you can see here on the left. So it can be satellite images, mainly for industry. It's electricity generation data for power emissions, but also individual flight and ship tracking for aviation and maritime emissions. And maybe just to deep dive into one example, so for industry, so here, this is where we leverage really the geospatial expertise that we have at Kairos, because we are able to assess the activity of each cement plant or steel mills that are regulated by the market. So we know where are the rotary kilns or the blast furnaces, and we can know, thanks to thermal signals, which are active or not, basically. And that's what we do every day with the algorithm to transform this into emissions. And on the right part, you will be able to see the accuracy of those measurements, which always had a very high accuracy compared to the official verified emissions. So you can see also the split for the different sectors, which are at the same level of accuracy. So now if we deep dive into the different sectors, so you can, yeah, go to the next slide, thanks. So first, when we focus on the first quarter, so as I said, this was really driven, so an increase of emission really driven by the power emissions. So this is what our German friend called a Dunkelflaute, which is a drop in wind and hydro production. So first, yeah, if we focus on the emissions, so on the left graph, you will be able to see that we were almost consistently above the level of 2024. So which is, yeah, again, quite surprising, because we all know that all the European countries are increasing their renewables capacity. But yeah, so if we deep dive into the different type of power generation, so we can see indeed this big drop in wind and hydro generation in the graph in the top right corner. So you can see that for wind generation, it's a drop of more than 10%. For hydro, it's a drop of 20% for the first half of 2025 compared to the first half of 2024. And of course, this has been compensated by a bigger share of coal generation and also gas generation. And if we focus on the specific country, so that will be the German example. So we also know that Germany is rely a lot on renewables to try to decrease its power emissions. But of course, when the weather conditions are not favorable for renewables, the impact is terrible for emissions. And so that's exactly what did happen in the first part of the year, where the renewables share moved from 48% in 2024 compared to 41% in 2025, so also for the first half of the year. And this has been compensated by gas moving from 12 to 16%, and of course coal moving from 22 to 27%. So that was really our observation for the first quarter of the year. But if you go to the next slide, we'll see that this phenomenon was then completely different. Indeed, there were some conditions a lot more favorable to renewables in two distinct periods. Sorry. So one first in May and June of this year, and the second one, so in which we are currently, so in August and September. So again, this percentage are so what we measure for this year compared to what we did measure last year. So if we focus on the first period, so in May, June, so this is a decrease of almost 20% compared to last year. And let's say the fun story behind those numbers is that solar electricity generation was EU's biggest power source for the first time ever in June. So you can see, for example, the different share of electricity generation in June. So solar was the biggest one with 22%, followed by nuclear at 21.8%, and then gas was only 15% and coal 6%. So indeed, yeah, it was then a completely different picture compared for the beginning of the year. Yeah, so it's also a decrease of 17% in August and September. So here it's really the combination of a strong wind and solar generation that enable the EU power emissions to be very low compared to the level of last year. So that's the full picture for power. If we now move to industry, so as I said at the beginning, this is the only sector for which we measure a decrease of emissions compared to last year. But this is not necessarily for positive reasons. So here it's a focus on steel. So steel, it's mainly because of Chinese overproduction, but also of a weak demand that we observe a decrease in emissions. Currently we observe a decrease of 6.3% year to date. You can see the graph here also on the right part. And this decrease is especially visible since May, so around the summer of this year. And I've highlighted two very interesting examples, I think, that explain this decrease in emissions. So the first one is so the steel mill of Duisburg, which is the biggest steel mill in Europe. So for this year, we observe a decrease of 30% year to date. And I highlighted two different reasons. So the first reason is really like an operational reason. They decided to reduce the steel production by around 2 megatons annually. So this is because of, as I said, a very complicated economical context. So because of Chinese overproduction with really cheaper costs, but also because of a weaker demand, especially due to the automobile sector. So that's for the, let's say, for the bad news. But there is also another phenomenon, which is an improvement of the technology to produce steel. So they just signed a 3 billion deal to develop a hydrogen-based green steel. So that will, of course, enable the plant to continue reducing their emissions, but also keeping the same level of production, which is necessary for Europe. Second example will be in France, in Dunkirk. We also observe a decrease of 35% year to date in emissions. Here, the reasons are not also very positive. So the plant faced a big maintenance of two blast furnaces for several weeks. That was also due to a very complex economic situation. And also here, the bad news is that a plan to also invest in green steel was rejected. So we don't know yet what will be the future for this specific steel mill. But yeah, this is the general context in Europe for steel. So this is a mix of yeah, economics, a very tense economic situation, but also improvement in steel, in green steel production that result in the decrease of emissions. And finally, so if you move to the next slide, we'll be able also to understand a bit more the numbers behind shipping emissions. So of course, for shipping, what's matter the most currently is the change in regulations. But there is also a very interesting trend in emissions. So you can see that emissions from last year, so the darker blue line, were very high, and especially compared to this year, so in orange. So this year we observe a decrease of almost 8% year to date. And that is mainly due to shipping emission fallback from a Houthi-led spike in 2024. So if you remembered, they were last year lots of attacks in the Suez Canal by the Houthi. So lots of vessels, so for example LNG tankers, decided to change their trajectory and use the Cape of Good Hope instead of the Suez Canal. But of course, this longer journey had an impact in terms of CO2 emissions. So for a single ship, it's an increase of almost 30% of its CO2 emissions for this trip. So that's why the level of last year were very high compared to this year, where we are back to a more, let's say, normal situation. So yeah, so that will be the different trends that we see in the different sectors, and happy to give you back the presentation and build.
Thank you, Paul. Very interesting. So then I will continue a bit kind of on the market dynamics and before kind of looking into the outlooks as well. Few elements that is kind of interesting now is the commitment of traders data that is coming out every Wednesday. It's a lot of focus on what the group of investment funds are doing at the moment, because we now see they have kind of, this group of investors has turned to a very net long positions. It's kind of for 5 consecutive weeks now, we've seen kind of very strong increase in net long positions. And the last time we saw kind of the numbers that was released yesterday showed the highest net long positions since May 2021. So it's really kind of a big shift in kind of positions here. It's mainly been more kind of build of new long positions and not necessarily kind of a huge reduction in short positions. But now kind of the question is, will something similar happen as we did kind of in early kind of January, February, where we had kind of this massive build-up and then kind of a sell-off as well, which was then kind of pretty kind of reflected also in the price. Or if this is more kind of this build-up and of long positions, taking into account kind of the future scarcity in the system. So I think kind of just looking at how rapidly it has been kind of increasing, of course there is a risk if some of these positions are now sold off into the market. But still kind of the underlying, we think kind of this underlying kind of bullishness in fundamentalism, or kind of that we kind of see why we see kind of this bigger increase in investment funds position. But again, kind of poses a bearish kind of short-term risk and maybe kind of capping a bit kind of the price increase going forward. For the fuel switching, this chart is showing the fuel switching price for 39% efficient coal to 50% efficient gas plants. And this is the Q4 fuel switching price, showing kind of the history up until now. And why I kind of picked Q4, I mean, it's roughly the same picture if you have the Q1 fuel switching price as well, is that these are kind of the winter months where we typically kind of will see higher gas prices and kind of more kind of push on prices. And what we've kind of seen for front month and front year, we've seen kind of that the CO2 switching price have been below kind of the EUA price, which is then incentivizing more gas burn than coal burn in the power mix. But what we have seen kind of in the recent 1.5 months is that also for the winter season, gas is more priced in to the power mix than coal. So of course, kind of this is also a reflection that the gas market is more kind of confident than that there is kind of sufficient supply to get through winter with kind of the current kind of build up in storage levels, even if storage levels are lower than at the same time last year. But that's more kind of coupled with this flexibility when kind of storage needs to be kind of at 90% levels, which was earlier last year. So for now, it seems like market seems confident. Gas is not kind of a problem for winter, and also kind of that you could allow for more gas burn, which is kind of then, as Paul mentioned, we had quite kind of a different picture in the beginning of 2025, where it was more kind of emission heavy from the power sector. But of course, this is something that is going to be kind of quite key to follow going forward when we're getting into colder season now, and with a focus on weather and kind of the gas market. REPowerEU, that is kind of the big unknown for maybe kind of not as much kind of the rest of this year, but of course kind of the in 2026. So REPowerEU is partly funded by the sale of EU allowances. It's a monetary target where 20 billion euros is going to be funded by the sale of EUA allowances. How it's done, it's kind of you borrow some allowances that was supposed to be kind of coming to the market from 27 and onwards, and you kind of have injected them to the market now to kind of speed up this transition away from Russian energy, oil and gas mainly. However, kind of what we have seen from 24 and 25 is that prices have kind of underperformed compared to where market was expecting prices to be when they kind of injected these volumes to the system. If we assume kind of a similar price, 2024 5-year-to-date price for the rest of the year, by the end of 2025, we will have reached 73% of the monetary target. The rest of this, so then the 28%, or sorry, the 27% that is then left needs to be kind of monetized between January and August next year. In July, the Commission adjusted the auction calendar for 2026, increased the volumes that was set aside for REPowerEU from 58 to a bit more than 93 million tons, so kind of increasing the volumes by 61%. Not necessarily kind of seems to be kind of a bit of a safeguard to not have to do kind of another adjustment again. But what is kind of important to understand is that these volumes will only come to the market through kind of the EU common auctions until we reach the 20 billion target. Once that target is reached, then these volumes will stop coming to the market. Next year, the EU common auctions, they're the ones that comes 3 times a week. They will be kind of roughly 3 million tons per auction. Almost 1 million of these is kind of the REPowerEU volume. So once you kind of hit this 20 billion, then you have kind of the risk of having auctions being reduced from 3 to 2 million in from one day to the next. How much volume will of course depend on the EUA auction price. If all of these 93 million allowances are coming to the market, then that means we have an auction price of say 58.6 euros per ton. That also means that we will kind of have everything that is in kind of scheduled in the auction calendar, and we will have the last auction 31st of August. However, if we have like now the year-to-date 2025 auction price of 71 euro per ton, we have 76 million allowances that will kind of come to the market. This means then we'll kind of have a cutoff in 21st of July. And then in a scenario where we have a 90 euro carbon price, will kind of have the cutoff on the 15th of June. So of course, kind of this uncertainty, we don't know the price yet for next year, but this uncertainty will kind of still kind of linger because we don't know kind of how much of these 93 million tons will be needed and will come to the market for next year. So that's kind of the joker and kind of the big kind of headache for market and market participants for next year. Another important thing that maybe is not necessarily kind of on a day-to-day important for kind of how the prices are moving, but of course it's going to pick up the policy debate, and that of course is like the 2040 climate target that is kind of the key element. I mean, the important thing here is like the stringency, flexibility, and competitiveness. And these things, I mean, we expected to see kind of the proposal from the Commission already kind of early this year. And then it took time because, of course, also Commission are talking to member states, policymakers, saw that, okay, without, there were not kind of necessarily kind of sufficient support for kind of a pure kind of 90% target. And then it took until kind of July before we had the proposal. And then we had kind of, which will probably be kind of the key component going forward, is the flexibility. The 90% target was kept, but it also kind of introduced some flexibility, which means not all of these cuts needs to come into come in the in Europe, but some then some of this target can be met by international credits. Key is, of course, kind of competitiveness of European industry. And that's where also kind of the flexibility comes in, and that will probably be the key to that we could see kind of some adjustment to this 3% international credits that is kind of proposed by the Commission. I mean, we've seen kind of Polish ministers asking for a 10% flexibility of international credits. So of course, kind of this was kind of on the top of the agenda when kind of the environment minister were discussing kind of 2040 last time. And this will also be key. But we see kind of it's difficult to reach this kind of a 2040 target. And they didn't kind of get it in time for the to get kind of a 2035 target before kind of New York and in the UN. But the aim is still to get kind of a 2040 target at kind of in October, end of October, when EU climate leaders will meet, which will then kind of also if we have the target, then we also kind of can derive kind of 2035 target, which will be important for the upcoming COP in Belém. Flexibility on the carbon removal. I mean, we knew that was going to be part of the review of the EU ETS coming up next year. But this is also kind of giving this was already proposed now that it will be part of the EU ETS as part of kind of the flexibility as well. So quite a lot happening. It's not necessarily kind of calm waters going forward on the policy scene. Very hard discussions going on, but this, of course, is key to follow as well going forward. Okay, so before we hit this is my last slide before we go into the Q&A session. A bit kind of what we foresee, both kind of a bit shorter term and longer term in Q4. As I mentioned, gas supply and storage situation ahead of winter. Currently, we're kind of in fuel switching territory, but if suddenly we have a switch, that could kind of also give a prospect of higher emissions if we suddenly get this reverse fuel switching again. December option expiry is always kind of something that is kind of adding some volatility to prices leading up to the expiry. I think kind of the biggest positions is around kind of 80 at the moment, but that could kind of dynamics around those position is going to be more kind of influential into the EUA price leading up to the expiry. Of course, it happens every year, but it's also kind of this focus that we'll have kind of the annual auction supply pause mid-December. So from mid-December, there will be no auctions. And of course, this less supply coming to the market is then also kind of going to is also kind of always like an underlying support in December. And then, as I mentioned, 2040 policy debate and target setting is, of course, key because that will inform also kind of set the boundaries a bit kind of what we can expect for the review of the EU ETS directive for 2026. Going into 2026, we have quite a lot on the supply side of things. We have the second cap rebasing, 20 million tons, kind of the cap is rebased this year or in 2026. As I mentioned, uncertainty over how much repower volume that is actually needed. And then we have something that is a bit kind of another kind of supply tightening element is that in 2026 we will also kind of have a maritime retroactive cap adjustment because shipping sector was introduced in 2024 and also the full cap to additional cap for the maritime sector was introduced in 2024. But the maritime sector only have 40% of compliance obligations. And this will be retroactively adjusted based on the compliance data that comes then end of September. So from kind of the auction volumes that is kind of in the auction calendar now will be adjusted lower. And then we kind of estimate around kind of 54 million tons lower because of this retroactive cap adjustment. And then, of course, kind of big focus will be on the review of the EU ETS directive. This kind of, when we kind of get the proposal by the Commission, we will see the, for instance, important will be the burden on the EU ETS sector compared to the other sectors, how kind of the whole framework will look like in the post-2030 world. 2026, we have like the carbon border adjustment mechanism starts, where free allocation begins to be phased out by some industry sectors. MSR still works, still active, works with a lag, but it's still active. From 2027 and onwards, the cap will be reduced at a faster pace. Just to kind of give you, it's going from 4.3 to 4.4, but roughly kind of each year, the cap will be reduced by roughly the size of a shipping sector. So that's kind of how quickly kind of, or how kind of ambitious the cap is then at the moment. We'll have kind of the secondary maritime retroactive cap adjustment for 2025 in 27. And then also these repower EU volumes that are injected to the market now these years, they are already borrowed from 2027 and onward. So of course, kind of supply will be lower because of this. MSR still estimated to be active, also tackling some of the repower EU volumes that have been injected to the market. And then 27, 28, we will have, I mean, these policy processes are taking time, so 1 to 2 years, and then we will have kind of an agreement on the new EU ETS directive. And then we have less availability of abatement option in the power sector, which means also kind of industry needs to increase decarbonization efforts, and also the price needs to reflect this the abatement cost in industry sectors going forward. So Q&A. We'll see if I can pull up the one question we had. Will I be able to watch the recording also afterwards? Yes, you will. You will kind of get access to the recording afterwards.
Yeah, and we do have lots of questions actually.
Yeah. Anyone you will pick up on from your side?
Yeah, sure. I have a first one that I can answer very quickly. So, why is biomass not seen as renewable? So, if you remember in the German electricity mix, there is two different columns, and it's just because biomass generation is much more stable than the other renewable energies, so solar, wind, and hydro, which depend on weather conditions. That's why just we separate the two columns. But of course, both do not produce CO2 emissions yet, according to the market regulations. So it was just for this purpose.
And I guess also the question is, can you please elaborate how shipping emission declined but increased 61%?
Yeah.
Yeah, just to make that a bit clearer.
Yeah, so on the comparison for the first half of the year, it was so the plus 60% is just due to regulations, because only 40% of total maritime emissions are taken into account in 2024, so were taken into account, sorry, and 70% are taken into account this year. But when you look at the global maritime emissions, so without taking this percentage into account, we observe a decline of almost 8% year to date. So this is just the regulations.
Let me see. We have kind of some. Oops, it's quite a lot of questions coming in. Sorry. It was kind of a questions regarding investment fund positioning. Commercial undertakings has decreased over the past four weeks. If that is kind of feed into why investment funds positions grew that significantly. I looked a bit kind of into the numbers to see kind of if I could see some correlation, like see something similar behavior in the past as well. Not necessarily kind of super clear. I think also maybe the commercial undertakings a bit kind of looking back to kind of a bit where fuel switching levels are at the moment as well, where we kind of see kind of now in the winter, it's expected kind of less coal in the mix. So of course, kind of if you have like some unwinding of hedges also for winter could also play some part as well. And also kind of we have compliance coming up as well in September, when we see kind of most are already kind of handed in the allowances for compliance. But it's something that we will kind of watch, of course, kind of carefully. And happy to, and please reach out to me after the presentation as well if you want to kind of discuss that further. So, I mean, it's one question for you, Paul. How accurate have you been historically in tracking emissions versus the official data? I guess you had kind of a slide on that already, that you were quite kind of, you had quite high accuracy, right?
Yeah, it was always above 97% for the total emissions. So yeah, so between 97% and so last year was 99.8% basically.
Let me see. Some recent observations of EU carbon is less correlated to power and gas than in previous years. Um, I think for 2020, I mean, we've seen kind of carbon being like super correlated, especially like in 24, part of 2023. 2024, it was basically kind of when gas moved, carbon moved in the same fashion. It is, and we see kind of some, especially in the beginning of the year, quite high correlation with gas as well. Um, Not necessarily because, I mean, both kind of last year and this year, we have not seen kind of carbon being close to fuel switching levels in these cases where it's been like super correlated. So in that sense, it hasn't meant kind of any fundamental reasons of why carbon and gas should have moved in just exactly the same fashion. It seems now that carbon is now steered more by not as much as, I mean, we have had like period of time where it's kind of not looked at fundamentals at all. We have had like weeks where there have been like low wind and sorry, high wind where prices have been moving higher, for instance, and vice versa. It's been very kind of technical driven, but I think this now kind of a bit more focus on carbon specific elements as well, especially with this like future tightness as well coming into play. Um, um, and I think that will kind of probably be a bit kind of what we are going back to as well, a bit where we were in the past, where we have kind of periods of time where it is like high correlation, typically kind of winter, and then of course kind of when the weather is cold, and that will have an impact on fuel markets, but also on carbon market because emissions are increasing or decreasing if there's kind of high levels of wind. And as well, kind of in the summer, where we see kind of the same fundamentals are kind of triggering the impact on both the uh, uh, kind of emission levels is very much steered by kind of what's happening on the weather side of things. And we have seen also in the past, suddenly, I mean, after COVID, carbon was moving very much with macro picture, even if it didn't have any fundamental reason why it should necessarily kind of follow macro in the US, but it did still. So of course, kind of at least kind of looking a bit kind of on the history, it's been kind of a bit kind of schizophrenic. Where it sometimes follow one commodity quite closely, and then in some other periods of time it has kind of done the opposite. I think we are running out of time, but I see one more question. What is your view on the free allowances reduction next year? When will the final numbers be published? Yeah, so I mean, we will have kind of a new benchmark update on the free allocation. Um, and that is, I mean, it should be ready kind of in Q4. Whether we will see the publication of the new benchmark already in Q4 is a bit kind of uncertain, or whether that will be kind of in the beginning of 2026. Because of course we don't have any visibility on the exact benchmark since the Commission is doing their benchmark, or sorry, the update as we speak. So I would say maybe kind of end of Q4, or it will kind of maybe be in Q1 2021 as well. We have some more questions. We might kind of, there are some with names and some without names. We'll try to get back to the ones at least with names offline. But I hope you all enjoyed this webinar. Just wanted to highlight one thing is that all of you that have participated in the webinar will get an email tomorrow with a complimentary offer to get a view kind of, or get kind of access to our daily EU ETS market reports for the trading week starting 6th to 10th of October. Of course, this is only a small piece of what we offer on the carbon side of our platform. And if you're interested in long-term, short-term, what we have on our platform, please reach out. And also we have kind of monthly Kairos data also available on our platform. Paul and myself will be at Carbon Forward in London together with my colleague Harry Öhman, where we also have a workshop on Tuesday, 7th of October. So if you're around, please make sure to stop by. There we will do kind of more deep dive into industry and a bit kind of longer term, where we do also our price forecasting up until 2040. Thank you, Paul, and thank you all.
Thank you, Ingvild, yeah, and thank you all.